Imagine waking up to find your crypto wallet hacked or your digital business brought down by a cyber attack, and there's no refund, no recovery. In today's digital world, your most valuable assets might not be in a safe or a bank. They're online. But what protects them? Let's talk about a growing safety net you might not have considered: insurance for digital assets. Hello, and welcome to Insurance World TV, your premier insurance education channel where we break down policies, simplify the jargon, and help you protect what matters most. Today, we're diving into a hot topic that's shaping the future of finance: digital and virtual asset insurance. With the rise of cryptocurrencies, NFTs, and decentralized finance, the way we store and grow wealth is changing fast. But so are the risks. So the big question is, can you really insure digital assets? And if so, how? Stick around as we unpack the risks, the types of cover available, and how to choose the right protection for your digital investments. Let's get started. Introduction. What are digital assets? Digital assets are intangible assets that exist in digital form and are owned or controlled by individuals or organizations. They can hold value, be bought or sold, and often exist on the internet or a blockchain. Common types of digital assets include: 1. Cryptocurrencies like Bitcoin, Ethereum, Solana. They are used for peer-to-peer transactions, trading, or investment. Number 2. Non-fungible tokens, NFTs. Unique digital items such as art, music, videos, or collectibles stored on a blockchain. Each NFT has a distinct value and identity. 3. Digital wallets and private keys. Tools for securely storing and accessing cryptocurrencies and NFTs. 4. Domain names. Digital real estate on the internet, often bought and sold as assets. 5. Tokenized assets. Real-world items like real estate or art represented digitally on the blockchain. 6. Data and digital content. Digital photos, videos, audio files, and documents that have value and ownership. Key characteristics of digital assets are: 1. They are stored electronically. 2. Can be transferred or traded online. 3. Often secured through encryption or blockchain. 4. May require digital wallets or platforms for access. Digital assets are everywhere, from Bitcoin to NFTs and even virtual real estate in the metaverse. But as we rush into this new frontier of digital wealth, one big question remains: what happens when things go wrong? Topic 1. The rise of digital and virtual assets. In the last decade, we've seen an explosion in digital assets. Cryptocurrencies like Bitcoin and Ethereum have gone mainstream. NFTs have turned artists into millionaires. And companies are building entire economies in digital spaces. What started as an experiment in peer-to-peer currency has now grown into a trillion-dollar market. Millions of people across the globe are investing, trading, and transacting in purely digital forms of value. And it's not just about techies or traders anymore. From artists minting NFTs to retirees investing in crypto funds, digital assets have become part of mainstream financial planning. But while the opportunities are massive, so are the risks. Wallets get hacked, passwords get lost, and sometimes entire platforms vanish overnight. The problem with traditional insurance. Here's the problem. Traditional insurance models were built for physical assets, homes, cars, buildings, not for blockchain tokens or digital collectibles. Think about it. If someone steals your car, your insurance can replace it. But if someone steals your crypto, who do you call? The blockchain police? That's where the gap lies. Most traditional insurers either don't understand digital assets or won't cover them due to the complexity and volatility involved. Traditional insurance wasn't built for this world. That's why we need new solutions. Ones designed to protect your crypto, your tokens, and your future. Topic number 2. Understanding the risks likely to face digital and virtual assets. Now that we understand the rise of digital and virtual assets, let's talk about the risks, and they are very real. Here are 3 most common risks. Risk number 1, volatility. The value of cryptocurrencies can swing dramatically in just minutes. What's worth $1 million today could drop to half by next week. Without any safety net, you could lose a huge portion of your investment overnight. The price of digital assets can soar one day and plummet the next. One tweet or regulatory announcement can wipe out millions of dollars in minutes. Imagine investing your life savings in a token and waking up the next morning to find it's lost half its value. Without any protection, you're exposed to the full brunt of that risk. The second risk is hacking and cyber attacks. Hackers are constantly targeting crypto wallets, exchanges, and users. Whether it's a phishing attack, a hacked exchange, or malware in your system, if your assets aren't protected, they could disappear in seconds. Unlike banks, crypto transactions are irreversible. If your tokens are stolen, there's usually no getting them back. Digital assets live online, and so do the criminals. Exchanges get hacked, wallets are drained, and if you lose your private key, it's game over. There's no forgot password for a decentralized wallet. If someone steals your crypto, it's almost impossible to trace, and recovery? Nearly zero chance. Third risk is the regulatory uncertainty. Then finally, there's regulatory uncertainty. Governments around the world are still figuring out how to treat digital assets. One day, your wallet is fine. The next day, the law changes and your exchange is shut down or taxed heavily. This shifting legal landscape makes it difficult to plan long-term or protect your assets with traditional methods. Different countries have different rules. Some embrace crypto, others ban it outright, and those rules are always changing. This legal gray area creates risks for investors. Your assets could be frozen, taxed unexpectedly, or even deemed illegal, depending on where you are and how the laws shift. Now that we know what we're up against, the big question is, can these risks be insured? And if so, how? Topic number 3, types of digital asset insurance. So, how do you protect yourself in such an unpredictable space? That's where digital asset insurance comes in. Let's take a look at the types of insurance available and how they work. There are 3 main types of coverage to know about. Number 1, custodial insurance. Custodial insurance covers your digital assets when they are stored with third-party custodians, like crypto exchanges or institutional-grade vaults. If the custodian experiences a breach, physical theft, or operational failure, this insurance helps reimburse customers for their losses. Example: let's say you store your Bitcoin on a regulated exchange like Coinbase or Binance. If that platform is hacked and customer assets are compromised, custodial insurance may cover the damage, depending on the policy terms. Let's break it down. How does custodial insurance actually work? 1. The platform, not the individual investor, purchases a policy from an insurance provider. 2. The policy covers specific risks like theft from hot wallets, employee fraud, or breaches of security systems. 3. If a covered event occurs, the insurer reimburses the platform, which in turn compensates the affected users. Important to know, Most policies only cover assets stored in hot wallets, those connected to the internet. Cold storage, offline vaults, is usually considered safer and may not be insured. Some custodians insure up to a certain limit, for example, $250 million or more, but this may not fully cover large losses in extreme cases. So when you hear a platform say your assets are insured, ask what kind of insurance they actually have and what risks are covered. Custodial insurance gives peace of mind, but it's not a blank check. Number 2, theft and loss insurance. Now, let's talk about one of the most crucial protections for any digital asset holder: theft and loss insurance. This is perhaps the most essential type for individual investors. Theft and loss insurance protects you against hacking, social engineering scams, phishing, or even accidental loss of keys or wallet access. Imagine clicking a fake link and losing your tokens to a phishing attack. If you're covered, this policy can help you recover the financial loss. What it covers. This type of insurance is designed to protect individuals and businesses from the most common threats in the crypto world, like hacking, phishing, SIM swapping attacks, malware, and even accidental loss of access to your wallet. Example: let's say you accidentally click a phishing link and a hacker drains your crypto wallet. Or you lose your phone and your private keys go with it. If you're insured, you may be compensated for the value of those lost assets based on the terms of your policy. How it works. 1. You buy a policy from a specialized insurer or platform. 2. You may need to prove best practices, like using multi-factor authentication, hardware wallets, or secure storage methods. 3. If a covered event occurs, like a theft or irreversible error, you file a claim. 4. After an investigation, you're reimbursed up to your policy limit. Important notes. A proof of loss is critical. You'll need logs, screenshots, or incident reports. Premiums can be high, especially for large portfolios. Some policies only cover hot wallet theft, not user error or negligence, so always read the fine print. Theft and loss insurance can be a game changer, especially if you're actively trading or holding large amounts. But remember, it's not a substitute for personal security. It's a safety net, not a free pass. Number 3. Liability insurance. Now, let's explore the third major type of digital asset insurance: liability insurance. Liability insurance is designed more for businesses, exchanges, and platforms. It covers legal risks tied to smart contract errors, failed transactions, or compliance violations. Example: if a crypto lending platform is sued because of a smart contract failure, this policy would help cover legal costs, settlements, and more. What it covers. Liability insurance is mostly designed for crypto businesses, platforms, exchanges, and service providers. It covers them in case they're sued or held legally responsible for mistakes, breaches, or damages related to digital asset operations. Examples of what might be covered. A DeFi platform's smart contract fails and users lose funds. A crypto custodian is accused of negligence in securing client wallets. A company is investigated for regulatory violations involving tokens or ICOs. How it works. 1. The business or platform purchases liability coverage tailored to digital asset operations. 2. If a client, user, or government body files a lawsuit or a legal claim, the insurance helps cover legal fees, settlements, or judgments. 3. This helps protect the company's reputation, assets, and ongoing operations. Important notes. Coverage may include errors and omissions, cyber liability, and regulatory defense. Policies are often custom-built for the platform size, Risks and jurisdiction. Premiums vary widely depending on transaction volume, risk exposure, and controls in place. If you're running a crypto exchange, a DeFi platform, or even launching a new NFT project, liability insurance isn't just smart, it could save your entire business. Each type plays a different role, so it's important to choose what fits your situation best. Whether you're holding assets personally, operating a crypto startup, or just exploring the space, the right insurance can be your safety net in a highly unpredictable market. As you can see, digital asset insurance isn't one size fits all. It's about choosing the right layer of protection based on how you store and use your. Topic number 4. Choosing the right insurer for your digital and virtual assets. Now that you know the types of coverage available, let's talk about how to choose the right insurance provider for your digital assets. 1. Check their expertise. First, look for providers with experience and specialization in the digital asset space. Not every insurer understands how crypto works. Choose companies that have a proven track record with exchanges, NFT platforms, or crypto custodians. 2. Understand the scope of coverage. Next, read the fine print. Make sure you understand exactly what is and isn't covered. Does it protect hot wallets? Cold storage? What about phishing attacks or user errors? Coverage can vary widely. 3. Compare premiums versus protection. Just like any other insurance, you want a balance between cost and coverage. Cheaper isn't always better, especially if it means you're left vulnerable in a crisis. 4. Evaluate customer service and claims process. When things go wrong, response time matters. Check online reviews, ask about claims turnaround time, and see how transparent the insurer is about the process. Remember, you're not just buying a policy, you're buying peace of mind. So choose an insurer that's equipped to navigate the fast-moving world of digital assets alongside you. Your digital assets, just like the physical ones, requires your utmost diligence when insuring. We had done an extensive video on how to choose an insurance provider. Please check it out here. Topic number 5. Protecting your digital future. Here is a summary of steps you can take to secure your digital future. 1. Proactive security measures. Before you even think about insurance, start with the basics. Protect your digital assets with strong, unique passwords. Always enable multi-factor authentication, and when possible, store your crypto in hardware wallets offline. Simple steps like these can stop most attacks before they happen. It's like locking the doors before buying the alarm system. 2. Get insurance. Next, invest in insurance. Not just for peace of mind, but as a key part of your risk management strategy. Just like you insure your home or car, your digital portfolio deserves protection. Whether you're a casual investor or a crypto business owner, there's a policy out there for you. 3. Stay informed. The world of digital assets is evolving fast, and so is the insurance industry around it. Stay ahead of the curve. Follow the trends, know your risks, and keep your protection strategies up to date. The more you know, the safer your assets will be. Your digital future is valuable, so don't leave it exposed. Secure your assets, get insured, and stay informed. If this video helped you understand the importance of insuring your digital wealth, give it a thumbs up, share it with your fellow investors, and hit that subscribe button so you never miss an update. Until next time, stay smart, stay secure, and protect your digital world.